Good afternoon, everyone. I'm Woon Heng, market economist at Mizuho Bank. This week's theme is of fear, greed, and falling knives. Amid the plunge in risk assets last week, reminders from various corners have emerged. These range from warnings about catching falling knives and advice to be greedy only when others are fearful. To be clear, fear undoubtedly reigned last week, with gold being buoyant and USD yields down almost 30 basis points as haven flight took hold. To be clear, fears are not unwarranted as reciprocal tariff paints conspire with weak economic data. The latter, while being overshadowed by trade fears, is important to recap as it reveals the extent of damage thus far and forms a backdrop which reciprocal tariffs will be layered on. Both US ISM manufacturing and services PMI were lower last week. For services, it is particularly notable that employment subindex sank into contractionary territory last week. Jobs report also showed lower job openings in the US. Last Friday's NFP print outperforming was no consolation as China announced retaliation by imposing 34% tariffs on all US imports, sending US and global equities plunging. Reciprocal tariffs, which were effective over the weekend, started with a 10% baseline for all trading partners, gave everyone at least a painful stab. That said, self-inflicted inflation worries from cost pass-through in the US will not be easily plastered over as consumers may begin to fret over the punitive tariff on major manufacturing nodes such as Vietnam. While optimists point to reciprocal tariffs being a ceiling one ought to remain pragmatic about the difficulty of negotiations and differentiate according to each country's ability to secure a seat at the negotiating table. Simply put, markets have every right to try and be optimistic should there be prospects of early talks among the G3 and or China. But the real economic impact on EM Asia peers will not be easily resolved, especially with April 9 being the effective date of the higher reciprocal tariffs above the 10% baseline. For the Fed, officials have come out sounding vigilant on risks on both inflation and growth fronts. Nonetheless, patience and paralysis over decision-making is difficult to determine. The problem with a patient stance, hinting at balanced risks, is that it does not fully capture the fact that risks have increased on both ends. Consequently, patience may need to give way to abrupt policy shifts on either end. Across the Atlantic, the euro has surged as narrative of US exceptionalism was being chipped away, but a unified response from the EU is far from clear apart from initial lamenting of a 20% hit from the traditional allies. Down under, while the RBI kept rate unchanged last week, and that was as expected, they also noted risks from Trump's tariff threats. Looking ahead this week, the RBI will look to cut rates by 25 basis points as India was not spared substantial US tariffs and earlier marked slowdown in growth momentum had already established room for easing. In Singapore, despite facing only 10% tariffs, after earlier easing in January, the MAS will likely ease the Sing dollar NER slope as woes was deepened. The risk of a Sing dollar near downward recentering has risen alongside escalating tariff threats. Meanwhile, in the Philippines, conditions appear ripe for the BSP to proceed with a 25 basis point rate cut amid the peso appreciation and moderating inflation pressures. The easing will provide more buffers in the face of growth headwinds. All in, EM Asia central banks will look to provide economic and financial stability for this week. Stability is very much desired in these volatile times, but monetary policy should not be mistaken as a panacea for offsetting punitive tariffs and falling knives. For more information, please refer to our research publication or contact your respective sales desk and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.
With a head cut